Tariff headlines have been driving the market. U.S. President Donald Trump reached a framework agreement with China on a trade deal, another of their armistices in their trade war. Trump says he plans to send letters to America's trading partners outlining unilateral tariff rates that Washington would impose. This development has weighed on markets this morning. We're joined by Laura Lau, Chief Investment Officer at Brompton Group. Great to see you.
Thanks for having me, Andy.
I see Simon Flint, who's a Bloomberg columnist, argues that investors seem to be shrugging off tariffs to some extent because, the U.S. market's near record highs. But he says these things can be economically damaging.
There's no doubt that there's already been some damage from tariffs, simply because whether it be consumers, whether it be businesses, they don't know what to do. And when you don't know what to do, you don't buy, you don't go forward with projects, you don't hire people. So that's the struggle. So I'd say that all around the world, we've seen not just the United States, but most countries downgrade their economic growth forecasts.
And it looks as though the U.S. and China will never reach full accord on trade. There's always going to be points of disagreement here.
Yeah, I agree with that. They both approach trade very differently. They both have different timelines, different negotiating tactics. So it's good that they do have some framework. And hopefully they're opening dialogue.
How are you playing it now? Are you avoiding stocks that could be vulnerable to tariff pressures?
So we already had, before the tariffs started, trying to, avoid them as much as possible. You can't do it completely. You just can't, especially since if it impacts economic growth. Let's be honest, almost everything is impacted. But what we have tried to do is decrease, goods exposure, decrease, exposure to consumers whenever possible. So we have tried to do that.
Broadly speaking, though, you don't want to. Economic growth is still okay. The economy, well, maybe the Canadian economy is shrinking. We don't know about the U.S. economy, but you don't want to be out of the market.
I don't think you want to be completely out of the market because we've seen where, when he decides he changes his mind, the market does go up substantially. So you don't want to be out of the market. And as we said, we don't believe the U.S. will go into recession because it does feel like if the news is too bad, we see, some of these things being walked back. So you want to be there because it could be 1 or 2 days. You've seen a V bottom, like in March, if you had sold, you're kicking yourself now. Yeah.
That's always the way, isn't it? Yeah. We're going to talk about some specific sectors and stocks that you like later. But tell us about the Canadian banks. How are you playing those, Laura? Because those stocks aren't far off record highs.
I'd say the Canadian banks, they had a few rough years. Everybody was very concerned over economic growth in Canada because they are a play on economic growth, and they're also concerned about loan losses. But, the truth is Canadians like to pay their mortgages. So the loan losses, what we have seen the last quarter is pretty well all the banks increase their loan losses, decrease the loan growth expectations. And I think that was largely expected. So what tends to happen is when things are bad, increase loan losses, and when things are better, it's not as bad as expected, you bring them into earnings.
Right, yeah, you reverse it, yeah. What about oil? How are you interested in oil stocks? There is a risk we keep hearing, it's not a new story, that Israel might launch some kind of attack on Iran's nuclear assets, and that would presumably tend to spike oil in the short term.
For sure. So Sunday, there's supposed to be negotiations between Iran and the United States for the nuclear agreement. So there's definitely some tension around that. And, it feels that Israel has told our U.S. that they could launch a nuclear attack if things don't work out. Because part of the problem is Iran has been enriching uranium for many years, and they're actually getting closer and closer to building 10 atomic bombs. So, of course, Israel is very nervous about that. So, and then, of course, Iran on the other side, we could attack U.S. military facilities. The other big danger is if they attack ships going through the Straits of Hormuz, which is a big bottleneck. 20% of the oil goes through there. So there is a real risk. But what tends to happen is geopolitical risk spikes. During these kind of events, oil goes up. If nothing happens, then oil comes down. Because there is still enough oil in the world as long as we don't have problems with the Straits of Hormuz.
What about the Canadian oil sands stocks? Are you interested in owning those? I mean, the beauty is they have decades of reserves.
So I would say on the Canadian oil sands side, I think we're all becoming a little more cautiously optimistic, is what I would say, with Carney and Tim Hodgson as the natural resource minister.
Right.
So we're getting more positive that there's a deal to be done, whether it be more pipelines, whether it be pathways to reduce CO2, or just a more friendlier environment to oil. So we are, cautiously optimistic on that side, so that oil sands producers can increase their production.
Up next, we're going to stay with Laura. She's very kindly sticking with us for a second block. She's going to give us an idea of what stocks and sectors she recommends. And we're going to get her take, Laura's take, on an opinion piece in the Globe and Mail that the big banks are responsible for a stagnant Toronto Stock Exchange. We'll be right back.